2020 and 2021 were unique years, and we can all point to the one factor that caused that. However, as 2021 developed, we started to notice some underlying market currents develop, things like inflation, interest rates, supply chain shortages, housing shortages, and labor shortages. So what does 2022 have in store for us, and how will it all affect the housing market? My name is Phil Wells, I'm a real estate agent serving clients in and around Spokane, and in this video we'll be looking at what the market is likely to look like in 2022 as COVID wanes, and the market begins to figure out what's stable ground again. Once we've established that context, we'll be asking the question, should you buy or sell in 2022? Is it too risky? Is it the perfect time? Or does the market even matter at all? So, let's get into it. Right now, I'm most interested in housing market projections and inflation as it relates to interest rates. But the whole market is an ecosystem, so let's look first at an article that outlines what top analysts from Wall Street banks are saying about the market in 2022. Looking first at the most pessimistic view on Wall Street, which comes courtesy of Morgan Stanley. With one of the most bearish outlooks on Wall Street, Morgan Stanley analysts predict a nearly 5% decline in stocks in 2022. The S&P 500 is likely to pull back next year amid tightening financial conditions and slowing earnings growth. The bank said, while our economists remain bullish on GDP growth for next year, we are haircutting earnings growth for higher costs and taxes in 2023. Now let's look at the most optimistic view on Wall Street, which comes courtesy of BMO Capital. Analysts at the firm are among the most bullish on Wall Street, predicting the S&P can reach 5,300 by the end of 2022, amounting to a 15% upside from the index's current price of 4,600. The bank believes that investors are too focused on inflation, which should moderate as supply chain kinks get straightened out next year. Combined with solid corporate earnings, that should continue to drive stocks higher in 2022, BMO analysts say. So we have the pessimist view being that as interest rates creep up, this will dampen the market and cause an overall decline. And we have the optimist view, which suggests that inflation concerns are overblown and this will all level out in 2022, allowing the market to gain further still. I'm not going to go over every single opinion that's detailed in this article from different Wall Street banks. I'll leave the article in the description to this video so you can check it out for yourself though. But the same market drivers kept coming up time and time again, namely interest rates and inflation. Only a couple of analysts actually mentioned COVID at all, which leads me to think that COVID is already priced into the market, and also leads me to think that COVID variants are also priced into the market right now. It's refreshing to not be at the mercy of a virus anymore, but that doesn't mean the outlook for 2022 is all roses. There are definitely some headwinds to be aware of. So let's dig a little deeper. Let's take a closer look now at what inflation is expected to do as we head into 2022. Again, I'll highlight both sides of the coin here, so no one can accuse me of steering the conclusion. Representing the pessimistic side of the debate, we have Saxo Bank. For the first time since the Second World War, US inflation could hit 15% in 2022, as a perfect storm of events creates massive price increases. So says Saxo Bank in its outrageous predictions for the year ahead. But the logic it sets out in its latest report does not seem so far-fetched. The prediction from Saxo Bank points to the labor market being the major cause of inflation in the next 12 months. It doesn't even touch on the supply chain issues that were mentioned by the analyst from BMO Capital. Saxo Bank suggests that as the last 2 years have pushed up many people's retirement and investment accounts, it's pushed them up so much that they can afford to retire early, and when the US eventually gets back to work, fewer people will be going back to work because so many took early retirement. So with 10.4 million vacant jobs in the US currently, it's going to prove harder and harder to fill all those vacancies. This will have an inflationary effect on wages, which will have a direct inflationary impact on the goods and services those companies produce. On the optimistic side of the equation, let's look at a survey conducted by Bank of America. Money managers are convinced inflation is transitory, wrote Michael Hartnett, Chief Investment Strategist at Bank of America. 61% of respondents to Bank of America's Fund Manager survey in November said inflation was transitory, representing a 3 percentage point increase from September. For those of you that don't know, there's been a debate raging for the last couple of months now about whether inflation is in fact transitory. It appears now at least that an increasing majority of America's top money managers believe it is in fact transitory. It's not uncommon for Wall Street to be wrong, just look at 2008. However, it has to be said that these people are market movers, so if they feel the tide is beginning to go out in terms of inflation, then that might be what ends up happening. We'll just have to wait and see how that all plays out. So there you have it, two sides of the inflation coin as we head into 2022. You pick which one sounds more plausible to you, and I'll of course leave the link to those articles in the description to this video. Now let's take a look at what interest rates are expected to do in 2022. Remember, interest rates and inflation are directly linked. If the definition of inflation is too much money chasing too few goods, then the only way you can resolve inflation is by either increasing the supply of goods available or reducing the supply of money. The federal government only has the ability to reduce the supply of money by increasing interest rates, so that's why we're focusing on this aspect. For this analysis, let's hear it from the horse's mouth, the people that are actually going to be the ones raising interest rates, the Federal Reserve themselves. In this article, they highlight a disparity between those that think 2 rate hikes are going to happen in 2022, those that think only 1 rate hike will happen in late 2022 and maybe another in 2023, and those that think the first rate hike won't be until 2023. Those that are more concerned about inflation are the ones advocating for rate hikes sooner rather than later, citing the inflationary pressures we're seeing from supply chain bottlenecks and labor shortages. Bollard said ongoing supply chain bottlenecks and one of the hottest labor markets since the Second World War could keep inflation high through 2022. Those wanting to hold rates low are in the inflation is transitory camp and see inflation reducing sharply in 2022. Yet Clarida struck the view echoed by Powell that inflation will slow sharply in 2022 to around 2.25% as labor shortages and supply bottlenecks ease. If we do see rate hikes in 2022, remember they're likely to be hikes of 0.25% at a time, not whole percentage points, so it's unlikely to be earth-shattering if it does happen. Now let's take stock of a few fundamentals of the housing market right now as we head into 2022. We know there's a housing shortage. The US is short about 5 million homes according to figures from the National Association of Realtors. And unless something happens that radically changes that, this situation will continue with us in 2022 and beyond. This likely means that demand for homes will stay strong into 2022 and beyond. In terms of house prices, national median house prices were up nearly 10% year over year in November 2021, which marks several years now of substantial home price increases. As home prices continue to creep up, the ratio of income to home price creeps up too. According to CNBC, that figure is now around 5.4. Financial gurus, people like Dave Ramsey, advocate that that ratio should be around 3. So as it approaches 6, I have a feeling that we're going to start to see more resistance when it comes to price, with fewer people willing to bid up on homes. Anecdotally, I'm already starting to see this resistance. I'm having more and more clients say things like, "This is not worth 500k, no way." I wanted to finish this section by looking at a recent article from Realtor.com. Now, the housing experts say the market is normalizing, but what does that mean? Will home prices and rents finally come down? Will more homes go up for sale? And what does the year ahead have in store for the real estate market? The 2022 housing market will continue to be a seller's market with fast-moving homes and rising prices, says Realtor.com's chief economist. But the competition should be a bit less intense than what we've seen recently. Home prices aren't expected to keep zooming up into the stratosphere in 2022 the way they did this year, so buyers can breathe at least a shallow sigh of relief. Instead, Realtor.com economists anticipate they'll increase at a much lower rate of just 2.9% in 2022, compared with an anticipated 12% rise in 2021. However, prices aren't anticipated to come down from the highs they've reached this year due to the continuing shortage of properties for sale and hordes of buyers continuing to enter the market. They just won't go up so much as quickly. I think this prediction pretty much suits everybody. Prices won't nosedive, so people will preserve the equity they've built up, and there'll be less competition for those people seeking to buy the homes. I hope this prediction is accurate. Now that we have the context of the market as we head into 2022 from a number of different angles, from a number of different sources, we can explore whether it might be a good idea to buy or sell in 2022. Looking first at buying in 2022, I want to start by making one thing plain. Timing the market or attempting to time the market is a fool's errand. Fundamentally, if you can afford to buy and you make contingencies, then you absolutely should. By contingencies, I mean things like, how will you pay your mortgage if you lose your job or your spouse loses their job? How will you cover the cost of repairs if you have a storm and insurance doesn't cover the damage? Things like a new roof, or what if your water heater goes out in the dead of winter? Owning a home is a phenomenal wealth building tool. Much like a tree, the best time to plant it if you want fruit was 20 years ago, but the next best time is right now. Remember too that one of the biggest concerns those analysts and money managers had was inflation as we head into 2022. And what's one of the best inflation hedges out there? the 30-year fixed mortgage. With a 30-year fixed mortgage, payments don't change for the life of the loan. That is an incredibly powerful tool. In 30 years' time, your grocery shop might cost 10 times what it does now. Gas, if we still have gas in 30 years' time, might be 20 bucks a gallon, and a new car might cost you 6 figures. But your housing payment in 30 years' time will be exactly what it was in 2022. Think about that. So if you are buying in 2022, you'll want to keep an eye on interest rates. I don't personally foresee any major rate hikes in 2022. I don't think the current administration has the stomach to rock the boat too much as we head into midterms. And while I know, yes, the Federal Reserve is independent, the president has huge sway over their decisions. Remember, historically speaking, interest rates are still really low. Only a couple of years ago, in 2019, mortgage rates with a 4 handle weren't uncommon, and the market was still pretty competitive then. I know this because I personally bought a home in 2019. If you're worried about constant price growth and not wanting to feel ripped off, then the article that we just covered from Realtor.com about a less frenzied real estate market as we head into 2022 should put you somewhat at ease. So to the buyers out there, I'd say check your fundamentals, buy within your means, and don't be too nervous about rates rising. Remember, they'll only rise a fraction of a percent if they rise at all. Annual payment won't change for the life of the loan, which means you're locking in a great inflation hedge. Now let's turn to look at things from the seller's perspective. If you're a seller, you've built up a ton of equity in the last few years, and it's tempting to want to liquidate those gains by selling. And I get it, a 6-figure check at closing sounds awesome, who wouldn't want that? Plus, it's tangible proof that you're an investing genius. But please stop and ask yourself what you aim to achieve by selling. I've been having physical therapy for a little while on my back, and my physical therapist during a session mentioned that he'd owned a home for a little while and was thinking about selling. Naturally, as a real estate agent, my ears pricked up and I asked him what he hopes to achieve by selling and what he'll do when he does move. It turns out he just wanted to sell to see how much he'd get for his home. He'd likely buy a similar home in a similar area once he's done. In my mind, that's not a good reason to sell. If you just plan on trading like for like, then the costs that you'll incur by selling just won't make it worth it. Effectively, you'll just be trading one inflated asset for another, and you'll be paying for the privilege of doing this. However, if you plan on upsizing, downsizing, moving out of town, or whatever it is that you plan on achieving, then yeah, 2022 might be a great time to release some of that built-up equity and get done what you want to get done. Equally, if you plan on offloading second homes or problem rental properties, then 2022 is genuinely one of the best times to do that. So to the sellers out there, I'd say please don't be distracted by the sale side of the equation. Remember, you still have to buy on the other side of the transaction. Does it really make sense for you to sell? If you're trying to achieve something, for example, you're trying to upsize, then yeah, 2022 might be the year where you release that built-up equity and put it to good use. And if you don't have to buy when you sell because you're offloading a property that isn't your primary residence, then now is genuinely one of the best times in recent history to realize some serious profits by selling. I hope you take away from this that the market is going to do what the market is going to do. We can't and shouldn't live at its mercy. We should instead be mindful of the market and protect ourselves against its worst excesses, but we shouldn't let it paralyze us into inaction. Take the time to review your personal financial situation, then take into account your personal goals and make a sound decision. That's my answer to the question, should you buy or sell in 2022? Like I said, my name is Phil Wells. If you're looking at buying or selling in the Spokane area, then give me a call, shoot me a text, send me an email, and I'd be honored to work with you. Until the next one, thank you for watching.